listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to the Daily Gold Podcast. With me today, one of my favorites, one of your favorites. He's Vince Lanci from Echo Bay Futures. He also writes The Gold Fix. And Vince, let's get right into it. We're going to focus mostly on the price action, the technicals on this interview, the market action. And so, I mean, interesting moves the last couple of days. Gold rallied after the Fed. The Fed said they're going to pause more or less. Then we saw, I know you'll talk about that. Then today we saw, or at least after yesterday, everybody getting excited again, looking like gold's ready to finally break above 2050, 2060. You get the jobs report, and there's a lot of selling on that. You know, a big red candle on the daily chart now. Not huge, but certainly a bearish candle. So why don't you take us back, because I know you have a real sense as to what's going on with respect to the market action and who's buying and selling.
Well, the first thing is just to go back. I think the, what do you call this? The key points or the signposts for the weekend, for the week, are the Fed, right? And what happened chronologically after the Fed wasn't just Fed based. It had to do with the banks, right? And then the second thing was that Asian reopening that we all like went crazy over. And then what happened during today's behavior after the data. Okay, so why don't we start with, I guess you want to start with the Fed, right? Right, so let's start with the Fed. So Powell comes out, and the whole point of this Fed meeting being important was this will have been the first time they've gotten to an end, or ostensibly an end of a hiking cycle, without breaking anything. Now, they have broken things. They've been fixed by the fiscal side, by Yellen, right? So this time he comes out and he says, we're done hiking for now. So we'll just call it a last hike with a bullish bias for more hikes. But we're done hiking for now. So he does that. Boom. And I don't know if he actually said it this way, but he said something to the effect of the banks are okay. Like that we survived, which, jumping ahead, this is why gold rallied. Gold rallied because it was the last hike. Stocks rallied a little bit because it was the last hike. And then the banks just collapsed again. The regional banks got attacked like within hours of him finishing his speech. And then gold started to rip because of that, because now gold was going up for two reasons. It was going up, number one, because the Fed was done easing and some people were betting on done tightening. And some people were betting on easing, which is a bad idea. And it was going up because more banks were collapsing. Every $100 that comes out of a bank, $90 is going into a money market, $5 is going into gold, and I don't know, maybe $5 is going into your mattress.
Okay, so yeah, looking at the price action, what I've been thinking coming into this week is looking at both the metals and the miners specifically. I mean, so far they're holding up very well during this correction, but there hasn't been enough of a correction either in price or time for them to begin another leg higher. So that's my view, is that there needs to be more time in this correction, be it, more time or price or both. And so I'm not surprised that gold is unable to surpass 2050 or 2060 this time. I think it was Monday or Tuesday. We saw it wasn't gold. It opened, it made a big move in the morning, and then it just came back. It wasn't able to hold on to that. So that action, and then you look at the candle from yesterday. I mean, that wasn't that strong of a candle. It's more of a bearish candle. It couldn't hold the gains. So, I mean, from my perspective, I mean, with respect to who's buying and selling and the futures market and all those mechanics, I mean, you're way better than me. You understand that completely. For me, looking at the pure price action, it just has looked to me in both the metals and the miners that they're not, there hasn't been enough of a correction yet for them to begin that next leg higher.
Well, I mean, well, that's why it's good, because A technician doesn't get involved in bias in a sense of, I think this company's buying. That's the stuff that I get involved in. I have to be careful of that. So if I come to a conclusion for a completely different reason than you do, then that's actually a good thing. Or maybe we're both just on drugs and we're doomed to lose money, but for different reasons. So your comment about, actually, I have a question. Your comment about when you said, paraphrasing, you said moving sideways or a deeper correction before we go higher. Is that mostly about the miners or mostly about the metal itself for you?
I mean, honestly, I would say it's both. I mean, looking at, because in the miners, at least in GDX, I've talked about this, we had what I call a breadth thrust. I mean, in the stock market, the market's coming off a bottom or a deep sell-off, and you get this breadth thrust where there's really strong participation, really strong momentum. In GDX, there's only been 3 of those in the last 10, 12 years or so. I mean, these data I'm looking at doesn't go back farther than that. But you had one in 2016 and you had one in 2019 when the Fed cut and the market kept running. I mean, it did have a little correction and had little corrections along the way, but it kept running. And so that happened in the last, I don't know, in the last 2 or 3 weeks, depending on how you look at it. And so that tells me that there's enough momentum and strength and breadth in at least the miners specifically, that I don't know, call it the medium term, is still that there's going to be another leg higher before there's a deeper correction. And by deeper correction in the miners, I mean something that's more than like 15%. It would have to be 20 or 25%. So they could still correct 10, 12, 15%, which they have done. But another example, even after last week, I look at the stocks in the Huey and GDXJ, the percentage, and I look at the percentage, how many of the stocks are trading above the 20-day, 50-day, and 200-day. And I like using the 50-day because, the 20-day is super volatile. But looking at the 50-day, even after a couple weeks of correction, it was still like 85 or 88% for the Huey and GDXJ. And so that's just too, unless you're in some kind of a blow-off move, that's just too high. That's too high for another leg higher that's going to be more than a couple days.
Right.
And so that's telling me that, we're going to see more of a correction here. And so, I mean, to answer your question, I think it's more so for the miners, but with respect to how gold is, the way that gold has acted this week, at least on specific days, is kind of confirmed that, that thinking with respect to the shares, it also makes sense with respect to gold. And I've also been with gold. I mean, I'm a little surprised at the strength because and maybe it will at some point. I mean, because I've been looking at 19, I mean, it's holding above 1980, but 1950 and 1900, for me, those are the downside levels that I'd be looking at. So coming into this week, I mean, I've been talking about those levels.
Right.
The
reason I asked you, and your answer is giving me the stock version of how I've been thinking. Okay. And that's, again, we could both be going to hell now because of that, or we could both be rich. So here's what I mean. I'm going to give it to you like a flow thing in the futures.
Or it could be both.
High. Gold makes a high. I'll just try and recap my thought process. Gold makes a high, 2030, makes that high at 2060, and then gets smacked down. And then I say to myself, that was what I call you understand it as a VWAP thing. Somebody sold the VWAP, somebody bought the VWAP, closed an order out, and now that's the capitulation of short covering, so to speak. And now we're going to come off because that's gold, right? Rally, the idiot momentum funds get stopped in the last leg. We spike, they get slammed down. It bases at 2030, and then I expected it to collapse, and then it didn't, right? And then it didn't, and I went, shit. It's really, now this is me with my own bias, right? Well, it didn't collapse, so it's really going to collapse tomorrow. I kept saying that and so 2 days go by, and then the Fed thing happens, right? Wednesday goes by, the Fed happens, and gold spikes, and I go, well, I guess I was wrong. In my mind, I had bought, I didn't buy, I was already long, right? I was like, well, I guess I was long. I guess we're going to keep going up. And we went up, and then we closed, and then Asia opened, which is what we're going to talk about next. And Asia opened, and then we got, in retrospect, it's easy to say now, and then we got that ridiculous stop in spike high. And now we're beginning the retracement. So my mindset, and I'm not saying yours is this way, but my mindset has been trained that after a $20 rally on thin air and a retracement, a slam down, as you described it, well, that's it. Well, now maybe it's like after an $80 rally, gold has to get slammed down. The point is there's more upside breathing room. And so I'm wondering, to comment on your comment, which was, I think there should be a bigger retracement. Maybe we don't get them anymore. Or maybe we do, but after a bigger rally. So it used to be 10%, a 10% blow off top, get you 20% sell off. Maybe it's a 30% blow off top, get you a 20% sell off. I mean, that's what I just saw in gold, and it kind of made me think. And I'm not being bullish. I'm not long speculating right now, but that's why I brought all that up.
And yeah, and one additional comment. I mean, some people don't like when I use the word tricky, but the tricky aspect of it is, okay, here's me doing my arm wavy thing, but it's legit. I mean, the gold setup, I mean, the technical setup, this is the most, at least for me, look at it. I mean, this is almost a perfect setup. I don't want to jinx it, but we know that if gold can take out 2100, this is a really significant breakout. And we know that when significant breakouts happen, they tend to happen when, too many specs are long. I've looked at the history, like, the specs get long, they're really excited, and the market still breaks out at that point. So it's like it's like a tug of war between, is gold in that are we in that breakout mode yet where the old, all the old parameters don't matter because gold's going to break out, and then tons of new spec money is going to come in and just overwhelm all of that. But at the same time, again, we're talking about looking at the price action. It's like, looking at these things, it's not quite ready to break out yet. So for me, I think that's kind of at least especially for someone like you, because you're more of a, I'm more of a buy and holder. But when you're following every day and you're, with futures contracts and all, I mean, all these things really matter.
Yeah,
it can be extremely difficult at this point in time because it's difficult to predict that exact. You don't know. I mean, next week gold could just, it could pull back for a couple of days, and then it could just blow through 2100, or it could pull back for another month or two.
Right.
It's really, I lean towards the pulling back for a month or two, but I don't know. I mean, is that me trying to be biased to being a contrarian, or?
Tell me if you
I'm
agree.
sorry. Go ahead.
Tell me if you agree with these statements. This is my feel being translated to a technician, right? Historically, until say this year, maybe, gold would rally, spike, get overbought, go sideways for a day, and they get annihilated. So if you're a Fibonacci person, 32% retracement, forget about it. 67% retracement, go to hell. It's going to 100% retracement of that move. And that's what happened. Now, this year, starting last year, but this year more so, I saw gold start doing this. 100% big move, overbought, 33% retracement, bought, 67% retracement, stop. And then you get these little V-shaped bottoms, and gold would start acting like a real market as opposed to just one that gets bought and then beaten up. And then I also see 2% moves on the upside in gold, which we had not seen historically. So what I'm coming to is this. What I'm coming to is, in the stages of a bull market, I don't know where these go because I'm not a pure technician, but you have the bear market is you get spike highs, you get overbought, and then you retrace 150% of the move, right? In bull markets, you get bull moves, you get overbought, you retrace 37% of the move or whatever the number is, right? And then you get V-shaped bottoms. Maybe we're in one of those moves. Like, for example, what do we drop today? $40? Something like that?
$30, it looks like. 31.
Yes. Okay. So if we don't come in tomorrow and drop in Monday and drop another $30, which is what you expect in gold historically, then I got to say, well, shit, if we don't spend a lot of time down here, then maybe that was our bottom. I mean, look, here's, as a trader, right? Talking to you as a technician, let's say I have 3 contracts to buy. I'm a buyer of 3 contracts at some point, right? Normally, I would buy none here and either buy at another $30 lower or buy one of the three contracts $10 higher. I would wait for a move, right? Now I feel like I could be missing a V-shaped bottom. So now on the three contracts that I want to buy one now. One if we go up. You follow me? Like, it feels like a different market, which, by the way, this is how we all get screwed. We say it's a different market, and then Monday it's down $150, and we're like, okay, so it's the same old goal. It just has a bigger range now. Anyway, so my question is, does that whole 150% retracement of the Fibonacci number in a bear market, V-shaped bottom, and now we're in this possibly even better thing hold, or am I just like,
well,
talking about?
yeah, position? I think I think we're definitely in a new bull market, and I looked at the bull market moves for gold, and when it's early in a bull market, unless it makes a huge move high, like 09, it was up 40% in 3 months or whatever that, or 4 months, and then it corrected 15%. Even after 76, and that move, like it didn't correct more than 8 or 10% after the first year. So when early in these new bull moves for gold, unless it gets really overbought and really stretched and has had a huge move, it's not going to have that big of a correction. Like even the one we had, was it February where it was down, what was that, 8%, February or March?
After Russia,
because I remember saying, and even at that point, like I was leaning towards being conservative. I was skeptical that, I made the point, in the January move, okay, if this is a bull market, it has to hold above 1800 for numerous reasons. And one of them was it shouldn't correct more than 8%. And I thought it was going to, but it only corrected 8%. And so I think we're still at that point when gold could only correct 6. It could still correct 6 or 8% and still be in a bull market. Like it could still come down to 1900, and that wouldn't change at least anything that I'm looking at. I don't know if that answers your question. And so last thing I'll mention is when gold is really hot, it bottoms with the 50-day early in a new bull market. When it's not as hot, it's the 100-day. If it's a big correction like you had in 09, usually it's the 150-day. So I've kind of been more focused on the 50-day and the 100-day. And so the 50-day right now is at 1960. And let me see where the 100-day is. So the 100-day is at 1914. Right. So for me, I think, potentially it could probably test the 100-day moving average. But so those are the moving averages when you're early in a new bull market and there's a correction. So I think we'll know, because the 50 days at 1960, 1980 are the recent lows. So if it comes down and it really, it does like a V bottom off the 50-day when it's at 1980, maybe that could be, that could be the bottom.
Okay. From my perspective, let me add to that. Not knowing those moving averages, I do know this: the biggest players on the fund side trade the 12-month moving average, which comes out to be like I don't know what it comes out to be, but it becomes this very big macro moving average. And then after they get in, the 50-day and the 100-day is where they trade their inflection points. So as the market's doing well, you'll see more of these guys add to positions at the 50-day that have already bought like $200 lower. So this 8% thing intrigues me though. So 8% is a historic number that comes from what? From the 1976 analysis you did?
I looked at, in bull markets, all of the corrections, like in the first year and a half. And the maximum tended to be like 8 or 10%, unless the market made a huge move higher, and it had already made like a big move, and so I know that's not a good answer, but my point is, I don't think the market has made a big enough move to expect more than a 8% correction at this point. And even, 20, what did it get up to? 2080. So it's like a 10%. I mean, that's like, I think an 8% would be like low 1900s, I think.
Right. Right. I mean, notionally, that's a big number because we're not used to it. But empirically, like statistically, it's a percentage that's not even, it's nothing. We're not talking about eggs or lumber here. We're talking about gold. Okay, yeah. So
Do you want to get into the Asian market and that buying?
I absolutely think we have to.
Okay,
because it dovetails into the overbought stuff. Okay. All right. So just to be quick about it, because I know that we're on a schedule here. After the US closed and gold was on the highs, Asia reopens and it just comes out of the gate and spikes up like 2% and then settles down up about 1%. So it went up to like a couple dollars short of the highs, like 2085 or something like that. And right away, I knew where the buying was coming from, but I wasn't exactly sure why the buying was coming. So I had to talk to a couple of people, and China was on Labor Day holiday. They have their own Labor Day. And that night was when they opened up again. So that was Shanghai speculative futures and fund guys buying after a week of physical gold was bought by Chinese going to Hong Kong. I mean, like the people that I know in China were like, oh yeah, they're just nonstop buying physical. So what ends up happening is the fund guys, the Wall Street guys in Shanghai are like, oh, everybody's buying gold. I should buy it on the reopen. And I think that there was a ton of buying being built up, like an order book before the open. And then on the open, Shanghai just fucking bought it. And it just came out of the gate and exploded. Now, the reason I feel this way is because of the information that I got. But to be fair, when it came out up 2%, I was like, wow, this is crazy. I might have missed the boat. I said that to myself, for a bigger trade. And then it backed off and I said, okay, this is it. And then I went to a technician that I work with, Michael Moore, and he has these big macro levels. And he said, we are either Elliott wave type stuff. Either we are in the end of a structure that's going to top out around 2060, 2070, or we're at the middle of another structure that's going to go to 22 or 2300. And when it went up there, he already said it a week before. He says, if it stabilizes above 2062, and the number moves, without penetrating back below it after it breaks it by $10, then we are on target for the bigger move. He said, however, if it doesn't stabilize above 2062 and breaks it by $10 and spends any amount, the subjective aspect of it, he goes, then the structure is over and a big retracement could be in play. Big meaning $50 to $150. And the day after that, we didn't stay above 2062. We got the first leg of that. So I am short-term bearish, but now I have a target, meaning the target is 50-day or 100-day moving averages. Would you say 1960 was the first one?
Yeah, the 50 days at 1960 and the 100-day is at 1914, and those are ascending at the moment. And so that's I'm looking at the 1960, and I mean, if gold stabilizes for a few days or maybe next week, then the 50-day could come up to that 1980 that gold has been testing. So that's right. I think that it looks like that could be the first level. And if gold, you'll probably get a bounce from there. If it's not that V type of bounce you were talking about, then it's probably going to come down to, I would say you also have 1950, but then even 1900. And the 100-day right now is at 1914. So that's in between those two levels of 1950 to 1900.
That's helpful because I do know that when gold is in a bear market, which is all too frequently, the 50-day and 100-day are the moving averages that they get slammed at. And so if we're in a bull market, you're going to at least pause at the 50-day and there's going to be buyers. The question is, will there be sellers? Now, historically, it's been the bullion banks, but I don't know that they have the balls anymore. Frank, they have too much money in central banks.
And so, yeah, my guess being conservative, like obviously I'm just guessing, I could be wrong. My guess is, and I guess I'm just leaning conservative at this point from what we were saying before. I'm skeptical that gold is going to bounce off 1980 and the 50-day and then rocket much higher. It's certainly a possibility, but
because we're scarred, because we have trauma.
Well, we're scarred. Yes. You're well, and that's something I've been, in a lot of the, content I've been putting out, and like, because I'm more of a long-term guy. And I mean, I know you're both, but you're more in tune on what's happening day to day than I am. But in the long term, I think the people are so scarred that they can't fathom that something, that this market could be in a real bull and have a huge breakout and run. And it's interesting because, also we can talk about this with respect to sports fans, because my buddy, I'm a huge Washington Huskies fan, and like, it's looking like we could have a great season this year. And my buddy, who's like, he's a professor, he has a 200 IQ, and he just talks about like, our fans are so scarred, like they're afraid to even like think that we could be really good. Like we'll be really good, but we might lose 2 or 3 games. And I'm just making, because I know you said that about Philly fans. It's like the same thing, how like you get, but isn't it the same thing how like a sports fan and like an investor, you could be so scarred by something.
It is. But here's the hope for us, at least for you and me and your listeners. If everyone who trades gold is incredibly psychologically damaged from 20 years of manipulation, bear markets, and false promises, the fact that we're talking about it means there's going to be another 5,000 idiots that are going to buy it after us, because at least we're in therapy right here, right now, trying to make ourselves brave enough to get irresponsibly long. So I think we're going to be late compared to the players, but we'll be early compared to the masses. That's what I think.
All right. Any, before we sign off here, I mean, I'll mention, everybody can find your stuff on Twitter and at Goldfix, right? So, I mean, tell our listeners where they can follow you, and also,
sure.
Any, if you want a final word or two on gold and silver right now.
Yeah, well, you can find me at, I have a newsletter, VBL, Victor Boy Larry, Goldfix, which is exactly what it sounds like, Substack. And there's a free version and a premium version. Sign up for the free. It's not going to spam you too much. If you sign up for the premium, Jordan has a link for like a 30 or 40% discount, and I'd be happy to pass that on to you guys. Besides, there's a free week. Anyway, you can find me on Twitter, but it's not even worth it. I mean, I'm active on Twitter, but I do too much shit posting. If you're a bullion person, I will say this. If you're a bullion person, I have to do this plug. I am partners. There's no money involved, but I am partners in a new Twitter account called, get this, Boobs Bullion. And the reason I did this is because I was so pissed that no one cared about some gold data that I put out. I said to my crowd, I said, you know what, guys? I should just put out a chart and a picture of a big breasted woman. Then maybe you'll look at it. And this woman said, hey, that's a good idea. I'll run it for you. And so I give her all these gold charts, not technical charts, like data, and she finds an attractive woman and puts it up there. So you want to look for, if you want to follow anyone, you want to follow for charts for gold and something easy on the eyes, you want to follow at Boobs Bullion. I think that's what it is. You want to go there, or go to Goldfix. The thing I wanted to add is do you think the thing I wanted to ask was, when are you going to do your next mobster show?
Hopefully tomorrow.
Cool. All right.
I think we're going to do it tomorrow.
Count me in. That'll be great.
All right, Vince. Yeah, thanks so much for your time. Really appreciate it. We'll get this out later, and we'll have to do this again the next couple of weeks.
We'll do it $100 lower. right? We'll drink hemlock.
All right. On that note, thanks for tuning in, everyone, and we'll talk to you again next week.
Thank you for tuning in to the Daily Gold podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.